Hello and good morning, everyone. Welcome to our free webinar, Back to Business Financial Strategies Related to COVID-19, presented by Valley National Financial Advisors. I'm Lauren Spence, Vice President of Major Events at the Greater Lehigh Valley Chamber of Commerce. We appreciate you joining us for today's program, which is the fourth installment of our Back to Business webinar series. A huge thank you to today's sponsor who made this free webinar available to our community, our presenting sponsor, Valley National Financial Advisors. We have two quick anonymous polls that will pop up on your screen during the presentation, so be on the lookout for those. You'll have about half a minute to answer each. Immediately following the presentation, there will be time allotted for question and answer. If you have a question for our presenters, you can type it directly into the Q&A box at the bottom of your screen. Questions can be submitted this way at any time during the presentation. We'll do our best to get to all your questions at the end. This webinar is being recorded for you and will be available on the Chamber website in our webinar library. Finally, if you're an attendee today, do not worry about being on camera. We cannot see or hear you. Now it's my pleasure to introduce our presenting sponsor and first speaker today, Chief Marketing Officer at Valley National Financial Advisors, Judy Ann Harris.
Hi, everybody. Thank you, Lauren, so much. We're so excited to be doing this with the Chamber. I just have a few things I'll go over with you guys very quickly, introduce our panelists, but I won't spend a lot of time talking because our panelists are very smart and I want them to do a lot of the talking. So let's kind of get started here. So I want to encourage everyone, as Lauren said, please submit questions anytime via the Q&A. We'll do our best to address all of them during this webcast. Just do keep in mind that these are financial professionals. So there are some compliance rules around giving very specific advice on individual situations. So we'll let you know if for some reason your question can't be answered directly, but they will try to answer it in a general sense. So just a little bit quick about us, the agenda you're all familiar with. It's something that was on the registration. It was on all the information you had. And I don't think there's a need for me to read it to you, but just a little bit about Valley National Financial Advisors. We're celebrating 35 years in business, and Valley National is a one-stop financial services firm. We integrate all of these different services under one roof so that our clients really have trusted partners for really their financial lifetime. And so we really focus on financial planning, wealth management. We incorporate tax, estate planning, insurance, pretty much a lot of the lists that you can think of. And you can visit our website to find out a little bit more about us. But we're really proud to be celebrating 35 years as a local and independent firm. And our team is really focused on clients first. That's sort of our motto. So I encourage you to get to know our team at our website, and I'll be posting links into the chat throughout so that you kind of have that information. And let's see. So this is our team of panelists today, excuse me. Lori Seberg is a CPA, CFP, and AEP. So a CFP is a certified financial planning professional, and an AEP is an accredited estate planner. Timothy Roof from our team, again, he's a CFP. And then Connor Darrell from our team, he is a CFA, which is a chartered financial analyst. And he is also the head of our investment department. So he'll be offering a unique perspective on the markets and the economy. I encourage you to get to know them and other people on our team. I posted a link in the chat. I could go on and on about how great they are. They're all very experienced at being on the radio show together, collaborating. We'll talk about the radio show later. And they've also, all of them have been quoted quite heavily in the media. So they're pretty reliable sources, I would say. So really quick, before we kind of jump into what they're going to talk about, I want to get a pulse on kind of where everybody is right now. And so we're going to launch our first audience poll. And you can see the question here on your screen. I want to find out how so far maybe this whole pandemic has changed the way that you're looking at your finances or your financial plans moving forward. I know for our entire team, it's changed everything. We are all working remotely since I think March 20th. But I also know that the economy, the markets, those have been big changes. There's been a lot going on with that have caused a lot of stress for, our clients. We've been able to help them through that. But the community at large, and I know many of you who are on this webinar have concerns around that. So I wanted to kind of get a pulse on, what's changed for you so far, or how you're feeling about more changes that might come. So, as we're kind of finishing up this poll time, I'll take this time to sort of reintroduce Connor Darrell, who's going to be the first one to speak. And he's going to touch on some of those things by giving sort of an outlook and an overview on, some of the market commentary that he's providing and the research that he's been doing as our head of investments. So with that, we can take a look at our poll results here. Very interesting. Give you guys a second to check those out. And then I'm going to go ahead and hand it over to Connor.
All right. Well, thank you very much, Judy Ann. Thank you, Lauren. And first of all, thank you to everyone who has joined us this morning. We hope everyone's staying safe and healthy through this difficult time. It probably goes without saying that we're in the midst of what will ultimately prove to be a pivotal event in world history. And we've been fielding a lot of questions from clients over the past several weeks about how to invest in this environment. But the truth is that there really isn't a playbook for something like this because it simply hasn't happened before. There have been pandemics in the past, and perhaps from an epidemiological standpoint, that the Spanish flu of 1918 is probably the best analog. But the world was a drastically different place in the early 20th century, and so we're kind of in uncharted waters here. So with that in mind, what I'd like to do with my segment today is just kind of try and set the stage a bit. Provide some context around where we are right now with respect to the market and the economy, and then hopefully provide some useful insight on kind of where we can go from here. So to start, I'm going to just kind of go through a version of the good, the bad, and the ugly, but I'll go in a slightly modified order where I'll talk about the bad news first. First, with the bad, the economy, it's widely kind of accepted at this point in time that the economy has entered into what is probably a relatively deep recession. The first quarter GDP number came in relatively recently at a minus 4.8% quarter over quarter, which is a pretty significant decline in a short period of time. And we're also seeing meaningful drops in retail sales data. Consumer sentiment, which is measured through a poll that's put out by the University of Michigan, is at its lowest level in about 9 years. So with all of that kind of evaluating that together, it's clear that we've kind of the economic engine that had been driving us throughout much of the past decade, it has started to putter out a bit as a result of all these changes we've had to make and these sacrifices we've had to make to kind of slow the spread of this disease. Beyond that, and kind of the ugly part of the picture, the labor market has basically been completely upended, as many are aware. The unemployment rate moved up into double digits recently, with April's jobs report showing that the unemployment rate came in at about 14.7%. But that number would have even been, there was a footnote in the report that suggested that the number would have been closer to 20% had certain workers been classified differently and had a different methodology really been used to kind of track that. And when you think about kind of coming into the year, we were below 4% on the unemployment rate. So it's been a really, really rapid change there. So no matter how you slice it, it's just an ugly number. But perhaps what's even potentially a bit more troubling is that the pain in the labor market has been disproportionately felt by people who are in lower paying areas of the economy and are less likely to have assets to kind of fall back on to help get them through this period where jobs simply aren't really available. And that's a big part of the policy response from the government and the Federal Reserve, and we'll touch upon that in a moment. But the one other item that's kind of on the pessimistic side of things is that the virus itself, the COVID-19 pandemic, is not really likely to be going away anytime soon. This is likely something we're going to be dealing with until a definitive solution is produced from the medical community. And our feeling is obviously like, no, we're not going to be in lockdown, kind of eating soup in our homes for however long that takes. But we are unlikely to return to a normal economy for quite some time. And I think a good kind of evidence of that is within the last week, China actually announced that it's placing another 100 million people back under quarantine after they saw some resurgence of virus numbers there. So while it is possible that we'll have these resurgences as things start to kind of resume and we start to try to find that balance between getting the economy going again and protecting the public health. So that's something that's likely to kind of weigh on the economy and on markets and kind of lead to perhaps a little bit of a gradual return to normalcy. I've heard a lot of different letters trying to be used to describe what the trajectory of economic growth is going to be. And, I've heard V recovery, W recovery. The one that I think probably is most reasonable, most astute is probably, I've heard Nike swoosh. That's probably the best analog that I feel might be most applicable here, and that you kind of have this sudden drop, and then we'll have this slow kind of gradual recovery back to normal. But flipping over to kind of the optimistic side of things, and this is something that we think absolutely should not be discounted by any means. It's an incredibly important consideration, is that policymakers, meaning both Congress, in a bipartisan manner, as well as the Federal Reserve, are doing absolutely everything they can to provide support to the economy during this time. And that policy response is historically enormous. As of now, the authorized spending on the fiscal side from Congress has been upwards of 12% of GDP. And there's likely more to come, because right now what we're doing is basically trying to preserve the status quo the best we can, help people and businesses to kind of tread water. And then the focus will shift from that kind of what I might refer to as aid to stimulus, where we're actually trying to kind of reignite growth in the economy. So that's important to consider. And then the other piece is obviously, and this is something that you kind of have to kind of really get through to thinking about, is that the pandemic itself is a temporary event. It's a transitory event. Eventually it will pass. The medical community will figure out how to address this, and we will be able to adapt as humans to kind of dealing with this virus. So with that as a somewhat sobering backdrop, of course, the obvious question becomes kind of, where do we go from here? And how should I be investing in this environment, this incredibly uncertain environment? And the answer to that question is something that's more unique to everyone with respect to the specific investment applications. So I'm going to focus on the first one and then kind of provide some generalities to help think through the second question. But moving forward in the near to intermediate term, our expectation is for continued volatility. And, even despite all of that uncertainty, markets have actually bounced really strongly off of the lows that we saw in March. And that's been something that's been rather puzzling for a lot of investors. And I've heard this referred to as the most hated rally in market history. And, while I would say that we too have been having some trouble with understanding some of the dynamics there, I think there's a couple of kind of key considerations for how to think that through conceptually. Why we're kind of seeing the market rally while we know that some of this economic data that I mentioned before is quite sobering. So firstly, I think an important consideration is when you're looking at the market and when you're looking at economic data, you're essentially looking in two different directions. Economic data is simply a measurement of the past, right? So the first quarter GDP number is a number that's released in April, which of course falls in Q2. And the unemployment data for April, for example, is released in May. So when you receive that data, you're essentially looking back in time, or at the very least, you're getting a measurement of the exact present. On the other hand, the market is really an anticipatory mechanism. The market really only cares about the future. So if the view is that, in the market, if the view is that things are going to start to improve moving forward, then you can have times where you see this divergence between what the market's doing and returns that you're seeing in the market as compared to the economic data. And I think that seems to be a lot of what we're seeing right now, is that the market's starting to anticipate that we're going to be able to begin opening up parts of the economy. And there's some optimism around some vaccines, but obviously those things are in the early stages, and there's a lot of uncertainty there that remains. But that's kind of what we're seeing there. The other major consideration here is that the composition of GDP in terms of how we measure economic output in the economy and the labor markets is very different from the composition of the stock market. If you think about the kind of the hardest hit industries, travel, hospitality, retail, et cetera, they make up a much larger segment of labor market and of the consumption component of GDP calculations than they do of the corporate earnings picture. And I think a good kind of way to think that through and kind of example of that is if you think about some of the large tech companies that are out there, like Microsoft, Google, companies like that, Those companies are huge components of equity market indexes. They're massive companies. And they really haven't experienced major disruptions to their business models. So what we've kind of actually seen in practice is that the rally in stocks and the rally across the market has not been super broad-based. Tech and healthcare stocks, as you might be able to kind of glean, have performed much, much better than say, consumer stocks or energy stocks. So that's another kind of consideration there. It's just that the market itself doesn't necessarily look exactly like the economy, as much as they are interrelated. Longer term, our kind of general assessment, as I alluded to before, is that we are going to be dealing with this situation likely for quite a while longer. However, with that said, our advice to longer term investors has been to simply stay patient and to try to be as unemotional about all of this as you can. The temporary, transitory nature of this event is an incredibly important detail for long-term investors. And while we don't know, and we have no way of knowing exactly how long it's going to take, we do have confidence that markets will achieve new highs again because they have done so throughout history. So we often remind people that trying to actively trade in this environment is just really, really difficult. And it's likely not something that's going to improve portfolio outcomes over the long term. And that doesn't necessarily mean you should never touch your portfolio under any circumstances. In fact, we think rebalancing is a very important consideration during periods like this. And I believe we're going to touch upon that a little bit later in the presentation. But to kind of start wrapping things up, we typically think in terms of maintaining what's called a strategic asset allocation. And a strategic asset allocation is simply the long-term asset allocation targets which are established for a portfolio through research and evaluation of a client's goals and objectives. And that's done kind of in the initial stage when you're trying to think through what your long-term goals are. And by asset allocation, I'm just referring to how much stocks, how much bonds should be in the portfolio. And that's something that should kind of align with your long-term goals. And our feeling is that our recommendation generally is that this is something that should be established and revisited regularly, perhaps once a year. But even beyond that, and perhaps most importantly, it's established objectively and without emotion. The shorter term kind of what we might call tactical portfolio changes tend to oftentimes be driven by emotion during periods of market dislocation and disarray. And there's very little evidence to suggest that we as humans have the ability to actually really implement those types of adjustments effectively, because to be successful with that, you essentially need to get that timing decision right twice. You have to be right on when to sell, and you also have to be right on when to get back in. And it's an incredibly difficult thing to get right even once. So to get it right twice is even harder. And our kind of general investing philosophy with the strategic asset allocation concept in mind is that if you want to make changes to your portfolio, it should be because you think your allocation could use an improvement. And that kind of assessment should be made independent of market views or what you think is going to happen in markets in the near term. Or the other reason would be if you have a kind of a long-term savings goals that have changed, your situation has changed, that would warrant a review of your strategic allocation and potentially an adjustment to the portfolio. So with that, I will kind of wrap up my segment. And since much of what I covered is kind of higher level perspective on the markets and the economy, and much of what I discussed was more related to kind of just discipline and remaining hands-off, I'm going to turn it over to Tim Roof, who is going to go over some of the key consideration regarding actions people can be taking during this unique and stressful time.
Thank you, Connor. That was some very useful information regarding the state of the economy and how to address investing during uncertain times. So what we wanted to shift gears on is to discuss a little bit about cash flow and what options you may have during these uncertain times that we find ourselves in. So for example, if you have been unaffected by the coronavirus related events, as you may be able to work from home or you are an essential worker, you may have determined that your spending has gone down, possibly dramatically during this time as your travel and discretionary expenditures have declined. So, what can you do with that excess cash flow that you may have within your portfolio, within your cash accounts and your bank accounts? Well, you can start to consider bolstering your liquid cash savings and reserves. And why you may want to consider bolstering your cash reserves is because a reserves helps you provide a cushion for your unanticipated expenditures and unforeseen circumstances. So, for example, you may have a job loss or a large repair or replacement or healthcare costs that you never would have anticipated, and these are unexpected. Well, maintaining a cash reserve helps you avoid having to obtain financing through high interest rate credit cards or other personal loans or other types of loans that you can go out and get and have to pay interest on. You could, use your reserves as a place to draw from rather than paying interest to a lender. So uh, we have just some general rules of thumb when it comes to holding cash reserves or the amount of cash reserves you may want to consider having on hand. And really have just broken this down into two segments, those for accumulators and those for retirees and near retirees. For those that are in the accumulation phase, meaning they have still a long time, a long time horizon before you're going to go into retirement, you may want to build and maintain a cash reserve of 3 to 6 months of your ordinary monthly living expenditures. And that would be the ordinary or necessary expenditures. Think of your necessary expenditures as your cost for your rent or your mortgage, your utilities, your car payments, those types of things that you have to pay on a monthly basis to live your normal lives and get to work. For retirees and near retirees, and when I say near retirees, that could be within a 3 to 5 year time frame of retirement. You may want to start to build and maintain a cash reserve worth 1 to 2 years of your expected distributions from your investments. In addition to providing a cushion for unanticipated expenditures, this reserve may also provide for your cash flow distributions if the markets were to underperform for a longer than anticipated time frame. So what this helps to do is it helps buy time for your investment portfolio to recover by drawing from your reserves rather than maybe pulling from your portfolio while the markets may be underperforming. So when you have your reserve, you may also want to consider, in addition to the ordinary expenditures or the upcoming distributions, think about those large purchases that you have. You may have a car replacement or a home renovation. Make sure to build those items into your cash savings as well. That way, again, you don't have to fall back on borrowing and paying interest in order to fund those large distributions that you may be able to plan for. So, switching gears a little bit to those that may find themselves impacted due to the coronavirus related circumstances, here are some options that to provide some awareness that you may want to look into and research a little bit further. So, for example, if you've experienced a reduction in hours, you may have been furloughed or laid off, consider looking into your state unemployment compensation. This may be available to you. You can go out to your state's unemployment website to review if you're eligible and consider filing a claim. One useful note at this time is that right now, with current unemployment applicants, they receive an additional $600 per week federal pandemic unemployment compensation benefit, which is in addition to the calculated weekly benefit under your state's unemployment compensation. So just be mindful that there is a little bit extra payment right now for those that may qualify for unemployment compensation. For self-employed earners and gig workers and proprietors, for the first time in history, unemployment may be available to you through the Pandemic Unemployment Assistance Program. Again, that same $600 per week federal pandemic benefit is available in addition to the calculated weekly benefit amount based on your prior earnings. And many states, just so you know, have established a separate pandemic unemployment assistance website where you could go out to review your eligibility as well as file a claim and refile on a weekly basis to confirm if you are eligible or not. Business owners, if you're a business owner, you may want to explore your options regarding the Paycheck Protection Program loan. This loan is intended to provide approximately 2.5 times the average monthly payroll cost, so you may cover your payroll, your rent, utilities, and mortgage interest. This loan may be eligible for forgiveness if at least 75% of the forgiven amount has been used towards payroll costs. You may check on the PPP or the Paycheck Protection Program loan details and how to apply by visiting the Small Business Administration website at www.sba.gov for further information. Another note, if you're looking to free up some cash and from your budget right now, is if you have federal student loans, you can contact your lender to defer those payments under the CARES Act provisions. This provides pause on making payments on on the student debt without interest accrual through September 30th of this year. If you can still afford the payments, you may continue to make payments while interest doesn't accrue on the loan through the 30th of September. So meaning you could still call your lender, say you would like to go into deferral on those student loans that you have. That way the interest doesn't accrue through September, but you could still make those principal payments if you can afford those payments. If you find yourself in the position that you need cash, there are also some retirement account options available to you for coronavirus-related distributions. And Lori will touch on these provisions in a few moments later during our webinar. Now, going into looking at what are some of the financial planning opportunities you may have at this time? Well, you can consider your investment allocation and rebalancing. For example, you may have noticed during the month of March that your portfolio was riskier than your expectation as the market pulled back dramatically through March. So you can assess your risk tolerance and determine if an allocation adjustment may be necessary. This could also be a good time to review raising cash for upcoming distributions over the next 12 to 24 months. That way, those funds are liquid and available for you when you require those distributions from your portfolio. You may also have incurred losses in your portfolio due to the stock market pullback this year. The IRS allows you to take up to $3,000 of capital losses per year to use against your ordinary income. So when rebalancing your portfolio, you may want to consider realizing some of those losses to use as an income tax deduction on your income tax return. And just a note, any unused losses are able to be carried forward to future income tax years in case you're not able to use them all in the current tax year. Moving ahead, the CARES Act provides a provision for the suspension of your required minimum distributions. We can't rule out RMDs as cash flow support, as you may still need to take these distributions if you are 70 and a half and you need the funds for cash flow purposes. But if you don't need the funds for cash flow purposes, or you have other accounts to draw from to support your spending goals, you could think about suspending your required minimum distributions in 2020 because the CARES Act does allow for the suspension of RMDs. So from a cash flow perspective, when you look at this, those RMD opportunities could be one of the following items. So for example, by suspending your RMD, your income may be lower, which you could provide a consideration towards converting IRA monies to a Roth IRA. When you do that, you pay tax on the amount converted from IRA to Roth in the year that the conversion takes place. And this may work in the circumstance that you expect your tax rate is lower this year, quite possibly, than it may be in future years. Or you may expect income tax rates to rise in the future. So take careful consideration of the options in regards to your income and possible Roth conversions. You can also consider suspending your RMDs for the standpoint that it could help reduce your taxable income in 2020. And depending on your personal circumstances, it could also reduce the amount of your taxable Social Security and even reduce future Medicare premiums in 2022 if you happen to find yourself paying an income-related monthly adjustment amount based upon your adjusted gross income. To get more information on this, you can go out and review the taxable income thresholds for Social Security and also visit Medicare.gov to inform yourself regarding the Medicare income-related monthly adjustment, income thresholds. Finally, suspending RMDs may also provide more time for you to recover from where you're, for example, let's give you a little bit of a picture here, is that your IRA accounts might have dropped in value due to the pullback in the markets from the beginning of the year. So if you suspend your RMDs, deferring into 21 could allow time for those IRAs to recover. And then that would help avoid some of the adverse effects of the market implications if you can allow that to continue to defer from here. So Lori will also be providing some further clarity regarding RMDs when she reviews the retirement account provisions under the CARES Act later during this webinar. Moving forward on what are some of the charitable contribution considerations that you may have. So the CARES Act provides a provision for a $300 above the line charitable contribution. So for taxpayers that currently claim the standard deduction, this allows those taxpayers to take a charitable contribution deduction up to $300, which is in addition to the standard deduction. Other charitable contribution options to familiarize yourself with would be the qualified charitable distribution from your IRA, also known as QCD for short. If you have obtained 70.5, you may give from your IRA directly to charity, and this would not be an income taxable event to you. So this is called, again, a QCD, and the maximum annual amount that qualifies for QCD is up to $100,000. And this, in years where we do have RMDs, remember, due to the CARES Act, the RMD is suspended this year, but years that we do have the required minimum distribution, it does also count, the QCD amounts count towards reaching your required distribution amount. I'd now like to turn over the presentation to Lori Siebert. Lori loves building personal relationships while educating clients on their options. So Lori, the floor is all yours.
Thank you, Tim, and Connor as well for speaking earlier. And just so folks know, we do provide a radio show called Your Financial Choices on WDIY Wednesday nights at 6 o'clock, and Connor and Tim are frequent guests on there where we can talk about the markets and the economy and general financial planning topics. So I appreciate working with them on this webinar today. Thank you to our webinar audience as well, and for the Chamber for organizing this, and Judy Ann for putting together these wonderful slides. We appreciate that. We do hope you'll find this information valuable in helping you or someone you know who's in need at this time. This is what we like doing, helping folks. Tim did touch base on cash flow ideas, hoping that that would be your first line of defense if you find that you're in a situation where you need to manage your cash flow. In addition, the CARES Act provides some options for tapping retirement accounts that otherwise would not have been available without penalties for some people. So I will talk about options, taking distributions or loans, putting it back if not needed, and I will talk about updates to the required minimum distribution rules for 2020. And that is one area that your head keeps spinning with required minimum distributions, because the rules just have changed a number of times just over the past few years. So let's start with talking about accessing retirement accounts. I want to remind people that there are folks out there who can access their retirement accounts now. My sister-in-law and brother-in-law called me and asked if they could take a coronavirus-related distribution from their IRA, and I reminded them that they're 62 years old and can already do that. So let's talk really briefly about some of the current rules of tapping retirement accounts where you don't have to worry about the 10% penalty. So if you have an IRA and your minimum age of 59 and a half, you can tap your retirement account, your IRA, without a penalty. And just as a reminder, we do still always have the income tax on these types of accounts when we take them out, other than a Roth. So IRAs, minimum age 59 and a half, you can take a distribution, just know that you have to pay the income tax. Roth IRAs, you typically have to have the Roth IRA the longer of 5 years or age 59 and a half to avoid income tax on that growth in earnings. Most of you know Roth IRAs are income tax free because we put the money in on an after-tax basis, but some people might not be aware of the 5-year rule, so just a little caution on that. But the original contributions can always come out income tax free. Some people have prior employer plans. If you were let go from your company, if you were at least age 55 in the year of termination, meaning you could have been 55 on December 31st, but you lost your job on March 27th, as long as you were at least age 55 in the year of termination, you can tap prior employer plans as well. The issue with, in our minds, we think 59 and a half, we can tap a plan. But there's a little caveat for employer plans. If you're still working, you need to still meet certain age requirements because that would be considered an in-service distribution if you're working. So your employer plan, you want to review your summary plan document. Your employer plan may not allow you to take a distribution just because you're age 59 and a half. Sometimes the age might be age 65. So you want to review that before you start taking money out of that. So there could be rules that already exist for you whereby you can tap certain retirement monies without using provisions of the CARES Act. So where the CARES Act comes in is what if you don't meet those requirements I just mentioned. So traditionally, if you took money out of a retirement plan early, you would not only be subject to the income tax, other than the Roth, as I mentioned, you would also be subject to the 10% early withdrawal penalty, unless an exception applied. And some of those exceptions may apply to you today without the coronavirus, without the CARES Act. Exceptions for distributions from the IRA differ somewhat from an employer plan. So again, before you act, what we really want you to take away from today's webinar is there are so many options out there. You need to investigate and make sure what applies specifically to your situation before you get excited and start implementing these things you've heard about. So exceptions for both IRAs and employer plans include death. We don't want that to happen. Substantially equal periodic distributions. Some people might have, that's a mouthful. Some people might have heard something called the 72T. That's where you do distributions equally and periodically, and there's a certain formula for that. That's always been available, so keep that in mind. Distributions pursuant to a divorce, which apply differently for IRAs than employer plans. That could be an exception to a 10% penalty for a quadro on an employer plan. But with the impact of the business closures and lost wages, the CARES Act offers some reprieve from the penalty for those people who are under the age requirements and don't otherwise qualify for an exception, if it can be considered a coronavirus-related distribution. And I think this is the piece that people keep missing when they hear that you can take money out of retirement accounts. What is a coronavirus-related distribution? To qualify as a coronavirus-related distribution, the distribution must be from an eligible retirement plan made on or after March 27, 2020, and before December 31st, 2020. Eligible retirement plans include traditional and Roth IRAs, as well as 401ks, tax-sheltered annuities, non-qualified deferred comp. That was one I had not even realized would qualify, a non-qualified deferred compensation plan. So though an employer plan may be an eligible plan, it does not mean that you automatically qualify. Employer plans are not required to allow coronavirus-related distributions. So that is another thing you have to remember. These are the flags that have to go up. You think, oh, I'm going to go take money out of my retirement account. No, your employer has to allow it. So they can amend the plan to provide for coronavirus-related distributions, which employers can do retroactively. If eligible, individuals can take up to $100,000 in total and recognize the income over 3 tax years. That's different than just taking a distribution out of your plan today. If it's not a coronavirus related reason, if you just take a distribution, you pay the income tax on it today. But the CARES Act says you can take up to $100,000, recognize the income over 3 tax years. That kind of lets you spread out that tax hit. And you're also allowed to recontribute some or all of the $100,000 within 3 years. So that's voluntary. You don't have to recontribute it, but you can. So the plan has to be eligible, but the individual has to be eligible as well. And that's called a coronavirus-related distribution. And this is, you know, you might think it might not apply to too many people, but they give us a little flexibility here. So the obvious are someone who's diagnosed with the virus by a test, someone whose spouse or dependent's been diagnosed by the test with the virus. But here's the wide open door. Someone who experiences adverse financial consequences as a result of the coronavirus. So this is broader eligibility. And it's, as it's written here, it's kind of opens the door when we say adverse financial consequences can include from any of the following: being quarantined, being furloughed, laid off, having work hours reduced. So a lot of people in our community may be still working, but maybe had reduced work hours. Some people are working 1 out of 4 weeks or 1 out of 5 weeks, or off 1 out of 4 weeks. So these are circumstances that could be interpreted broadly to make you eligible as an individual, again, if you're eligible to take from one of those plans we mentioned. So keep this in mind. And again, back to Tim's conversation about cash flow and emergency reserves, thinking that through and kind of preparing yourself for these kinds of situations. It doesn't have to be a pandemic or a coronavirus. It could be a loss of the job in your future. So that's why it's so important to stress cash reserves and short-term funding needs for your big, large purchases and things like that. So you have to find out if you have an eligible plan and if you are an eligible individual. Let's say you went ahead and took advantage of that and took the distribution. You could pay the tax out over 3 years, but then you find out in year 2, you get the most awesome job ever, one you were hoping for your whole life. You're making tons of money now, and you really didn't need that money after all that you just took out and paid all that tax on. You can recontribute it. So that is another benefit that normally could be more complicated. So you can recontribute it again if you had a coronavirus related distribution. So you want to make sure that you qualify under that, and maybe even document that scenario or sequence of events that occurred that made you take out that original distribution. And you have 3 years to put that back. It does not have to be the plan from which you took the money, but the plan must be able to accept the rollover. The recontributed amounts are treated as though they're a direct trustee to trustee transfer within 60 days. And as a result, the original distribution that you already paid tax on is not subject to tax. So you want to amend your tax return to get those taxes back that you paid maybe in that first year. So you go back, you amend that prior year tax return where you reflected the distribution as taxable. Now you say you put it back, and maybe it was only part of it that you put it back. You don't have to put back the whole thing. You amend your tax return and you get your refund back. So again, this could be an option if you're in desperate need of cash. Remember that you have the tax to pay, so you'll only benefit from that net tax, the net amount after tax. Let's go to what if this is not an option for you. You really need the whole amount. You don't want to have to pay the income tax. there is something called a coronavirus related loan. So another way to quickly remove money from a retirement account is a plan loan. Employers can allow and administer plan loans from your 401k, tax sheltered annuity, or government plan. If you do not have a coronavirus related reason for the money and your employer allows loans, so in this case, again, I'm going back to what if you don't have a coronavirus related reason? You can take the lesser of $50,000 or 50% of your vested benefit as a loan. Again, if the employer allows for loans, you would just have to pay that back, and you have 5 years to repay the loan. If you have a coronavirus related reason, similar as to what we discussed for distributions, the CARES Act gives you additional benefits. As with plan loans associated with disaster relief, that's where this kind of came off of. Coronavirus related plan loans have increased limits of $100,000 and 100% of the employee's vested benefit. So they increase the amount. Again, it has to be a coronavirus related reason. In addition, if a qualified individual has a loan payment due date after March 27, 2020, and before December 31st, 2020, the due date is delayed 1 year. So if you take out a regular loan for a non-coronavirus related reason, it's $50,000, 50% of vested balance, no more than that, and you have to start paying it back immediately. If it's a coronavirus related reason, it can be up to $100,000 or 100% of the vested balance, and you don't have to start paying it back for a year. So anyone who would qualify for a coronavirus distribution would qualify for a plan load, provided, of course, that the individual's employer amended its plan to allow it. So caution, if you are an employee and your job is terminated and you have a loan, it might have to be fully repaid. So again, you have to kind of think through all the threads of your decisions and what might be that impact in the future. If you don't repay the loan, then they're going to tax it to you. The entire loan balance would be income tax, and that original contribution would be taxed. So you want to be careful of that. There are some provisions that allow you to pay it back, roll it back into the plan. So that could be something to explore as well. Kind of treat it like a rollover if you do have the money. So some of the advantages and disadvantages of the coronavirus related loan. Loans are not income taxed if they're paid back, unlike the distributions, which are taxed unless it's a Roth. A loan repayment can be stretched out over the 5 years, whereas the coronavirus related distribution, if you decide to repay it, it's within 3 years. And the disadvantage for the plan loans is though they must be repaid, and if cash flow continues to be an issue, you still, have an issue there. So think of all of your options when you're considering that. Earlier, Tim touched on required minimum distributions. Real quick, the old rules, you had to take out your required minimum distribution out of your retirement accounts at age 70 and a half. The Secure Act updated that and changed it to age 72 for anyone turning beyond age 70 and a half at 1/1/2020. So they already had kind of extended it, and then we were hit with this pandemic, and the CARES Act came in and kind of modified it a little bit. As Tim mentioned, they waived the requirement for required minimum distributions for 2020. If you already took your required minimum distribution in January, you're kind of stuck and you can't return it. That's a question several folks have asked. Can I put it back? Well, not if you took it in January, not if you are a beneficiary of an IRA and you already took it. You can't pay it back or put it back. But if you were 70 and a half or older and you took it out between February 1st and May 15th, you can return it by July 15th. If after May 15th, you just follow the regular 60-day rule to return it. Again, beneficiaries cannot return it. But if you haven't taken it yet and you're a beneficiary, you don't have to take it. So beneficiaries are also waived from the required minimum distribution. let's see, you can also, some people might want to wait to decide if they have to take it, but year end they're doing their tax planning and they might realize it's a great idea to take a little bit of that required minimum distribution. If it's not required and your required minimum distribution is like 50,000, you could decide to take 10 if you need it for cash flow. If you don't need it for cash flow, as Tim mentioned, maybe you want to do a Roth conversion. So you just want to make sure that you're carefully considering that, because there's circular tax calculations when we have taxable income and Social Security and Medicare premiums that could be adjusted. So watch out for that. And as Tim mentioned, qualified charitable distributions are certainly something that you can consider as well. And if you're already 70 and a half, can continue to do that. So we've discussed some of the economic considerations of the current situation, some cash flow ideas that may be needed, and changes in the rules for retirement plan distribution options. As financial planners, we want to stress the importance of considering the impact that any decision you make should be considered in conjunction with the impact it may have on another area of your financial life, as we've tried to highlight today. These decisions impact your cash flow, but also your taxes, your retirement plans, your investment performance. So I'm hoping that Tim could take a few minutes to talk about how an individual might be strategic in their financial decisions when potentially taking distributions or contributing for that matter. Tim, can you walk us through that a little bit?
Certainly. So as we continue to move forward, it's good to plan ahead for those future distributions, as we discussed, and determine your income tax implications when you're planning on distributions from your portfolio. Careful assessment of these factors may produce valuable long-term savings for you. In addition, when planning for upcoming distributions, it may be a good time to reassess your risk tolerance, as we touched on previously, and determine if rebalancing of your investment portfolio is necessary at this time. Connor, in regards to rebalancing, do you have anything else to add?
Yeah, thanks, Tim. So we real quick, we did talk a bit earlier in the presentation about maintaining that strategic asset allocation targets, and where the portfolio is in relation to those targets should really be a key consideration when withdrawing from the portfolio and in determining when to rebalance. So for example, if my portfolio has more equities in it than the strategic allocation calls for, the recommendation should be that I should consider selling more equity to fund my distributions or my withdrawals from the portfolio. And this can be difficult in practice because often if something has become a larger component of your portfolio over time, it's likely because that investment has done very, very well. And vice versa, it can be really tempting to want to sell something that has underperformed, because we all have that tendency to want to kind of stop the bleeding, so to speak. But adhering to that discipline when rebalancing and when deciding where to fund withdrawals from helps us to really adhere to that kind of old adage of investment discipline, buying low and selling high.
So what would we like you to take away from this webinar? For one, now is the time to get informed and learn about the CARES Act legislation and the provisions within it, and also look into other planning opportunities that may be applicable to your personal situation. Take the time to do the research and review your options. There is a lot of information available from various sources to familiarize yourself with new and prior developments. And finally, seek advice by reaching out to a trusted financial or tax advisor prior to making any irrevocable decisions.
All right. Thank you so much to all of our panelists. This is Judy Ann again, just hopping back in. I wanted to just mention a number of resources that are available from our team before we get into the Q&A. Obviously, our website, valleynationalgroup.com. Lori mentioned the radio show on WDIY is called Your Financial Choices. It also has a website where you can listen to past shows that have been recorded. You can do a search for different topics. And Lori also answers questions each week on that show. So there is a place on that website to submit questions. If you don't submit a question today or you think of something later, Lori's always always happy to address those things on her broadcast. So I welcome you to kind of visit that. I'll be putting a bunch of links up for everyone. And then finally on our website, obviously you can follow us on social media. The links are here, but they're also on our website. And we do a weekly newsletter from our team called The Weekly Commentary. And you can sign up for that at valleynationalgroup.com. And you'll get it every Tuesday morning, and it has a collection of really updates and insights from across these wonderful people that are part of our team. So I encourage you to use those resources. And let's see, where are we? So before we get into the Q&A, I wanted to ask one more question of the audience. We want to kind of get an idea of what other financial topics would you guys really want to learn more about. Obviously, from what you've heard, our panelists and other members of our team are a wealth of knowledge, and they love to educate people and engage with our community and help as many people as they can to make the right financial choices. So we really want to put this out there to see where there might be interest in particular topics that we can make sure that we're providing the type of information and insight that you guys are really, really looking for. So I welcome you to kind of respond to that. And let us know what you're thinking. And if you have another topic that you have in mind, please feel free to write it into the chat or in the Q&A, or contact one of us via the website, the link that I posted there before. Actually, I'll put all these other links up now for you guys. I know it's a bunch of links, but I figured it's a little bit convenient. And for anyone that doesn't know, in the chat, there is like 3 little dots at the bottom where I think you can click it, and there's an option to save the chat. That will allow you to keep all of these links and all the other little bits of information that have been put out during this webinar. So just a little kind of technical side note. So great, it looks like retirement planning checklist is one of the popular ones, but also wealth management. So I will definitely take that back to the rest of our team and see about trying to get some other webinars set up on those topics. I appreciate everyone's engagement and feedback. So I'll turn it back over to Lauren to facilitate our question and answer period.
Thank you so much, Judy Ann. Thank you so much to all of our presenters. That was such a wealth of information. Oh gosh, no pun intended. We're going to now jump into our Q&A. Lori did an excellent job of addressing the questions as they were coming in by typing responses. So you can see those by opening the Q&A box at the bottom of your screen and clicking on answered. I definitely encourage all our attendees to type new questions and submit those to us, and we'll certainly address them. In the meantime, I figured we could look at the questions that Lori answered and submitted typed responses to, and kind of expound upon them out loud. So looking at the first question that she answered, someone asked, I am self-employed and am now eligible for pandemic unemployment assistance, unemployment for self-employed people, but I'm still making some money. Do I still qualify for benefits? Lori, do you want to provide a little bit of insight into the response that you provided?
Sure. What's been so interesting about the evolution of these stimulus benefits that have been provided through the CARES Act is actually navigating them and understanding them, because we sometimes receive new information day by day, and it's new for all of us. Self-employed people typically don't qualify for unemployment compensation because they don't typically pay into the system. So when this benefit came out where self-employed people could apply for unemployment, it kind of put the state into a flurry, and they actually had to open up a whole new portal for it. And so prior to that, people were filing under the unemployment compensation website and then had to pivot and switch to this other one. So there was some confusion. People were getting denied, and they learned through the CARES Act that they would qualify for unemployment. So it was very confusing. And one of the other benefits I think Tim had mentioned too is the government provided this additional $600 a week to people who are filing for unemployment. So the question came up with self-employed people. Sometimes they might still have some income, and the unemployment folks had let one of our clients know that she should continue to apply because her income is way down. So she would continue to apply each week. And if she applies for some amount of unemployment, she still also could get that extra $600 benefit through the CARES Act. So there might be weeks that fluctuates, and there's a range that they indicated to her that she would be within. And if she's over that range, then she would not qualify for the self-employment. If she's within that range, she would qualify for some, if not all, the eligible benefit that she would have. So I encourage people to go check this out, especially if they're self-employed. It's made a real difference for some of our folks who are like photographers and have that kind of gig work that if they're not allowed to go out and do these events, they really are hurting right now.
That's really good to know. Thank you so much, Lori. I don't know if Connor or Tim wanted to add anything to what Lori said.
Your response is spot on. That was great, Lori. Thank you.
Perfect. Thank you, Tim. All right. We have a couple other questions that were submitted regarding required minimum distribution. I know you did cover that in the program. So I'd say let's look at the second one. The individual asked, I don't need my RMD. Should I convert some IRA money to a Roth if my income is lower because of this? Lori, I know you addressed this one as well.
You know, we look at whether people should convert IRA money to Roth regularly as a tax preparation office as well. So it is something to review. What was especially tantalizing in 2020 is if someone doesn't have to take their required minimum distribution, does that open the door for us to do a Roth conversion? So if folks don't need the money for cash flow, they don't need to take their required minimum distribution, they're not required to take it for 2020, what we might look at then is their tax return to see if it's worth doing a conversion where we can play tax brackets. So typically we would like to do a conversion when you're in a low tax bracket, and maybe in the future you would be in a higher tax bracket. But for people who are taking required minimum distributions, certain folks, it really spills their income over certain thresholds. It makes their Social Security taxable. So it's a science. It's a bit of a science to make sure that we're kind of playing the tax brackets to the best advantage, whether to do a conversion. And what I often caution people on is you might look like you're in a low tax bracket, but the more income we put on your tax return, the more Social Security gets included in your tax return. So for some people, their income's so high, it's automatically included at 85%, which is the cap of Social Security. But if they're in a lower income level, if we added $10,000 of a Roth conversion onto their tax return, it could throw $5,000 to $10,000 or $8,500 of Social Security, taxable Social Security onto their return. We might not want that. So just watch out when you're planning for Roth conversions that you're considering all the other items that may be impacted, which could also include Medicare premiums could go up if you're over certain thresholds.
Thank you so much, Lori. I don't know, did either of our other panelists want to add anything?
It's a fluid situation, so it's important to really, take a look at things and take an assessment of your income to date for the year, as well as looking at projecting what other income sources might be through the end of the year before you go ahead and make a decision regarding converting monies from IRA to Roth. And as Lori suggested, that there are other impacts and considerations that need to be reviewed, such as how much of your Social Security may be taxable. Will this have an effect on my Medicare premiums? So again, just making sure that you cross your T's and dot your I's before you make any final decisions regarding the conversion, because now conversions can no longer be undone or recharacterized back to IRA later on. Once you make that Roth conversion, it is irrevocable.
That's a great point, Tim. This is Lori again. And one other consideration some people don't think about is that you can actually convert in kind. So if in your IRA you have some positions that are down that you actually expect could go up, you could actually convert in kind positions from your IRA to your Roth IRA. It goes in at the fair market value on the day of conversion. So there's some even deeper options on Roth conversions than are first apparent.
Great. Thank you both so much. I think we have time for one last question. So this one was submitted in the chat. Regarding charitable contributions, what is the best approach to help our community through this time in a tax-effective manner?
Okay. Let me just, I'm looking at the question. So help our community through this time in a tax-effective manner. Charitable giving is a priority for me as well. And so there is a lot of planning that you can do around charitable giving. Tim had mentioned, for example, the qualified charitable distribution people can do from their IRAs. If you're 70 and a half, that can continue even if you don't have to take your required minimum distribution. Another great option, and this is available anytime, it doesn't have to be just in this year, is that you can make what we call bunching your contributions, where you do maybe 5 years worth of contributions or 6 years, and fund a donor advised fund. And in that way, you get the charitable deduction all in 1 year. It kind of bumps you up to be able to take advantage of itemizing when you otherwise might have only been eligible for the standard deduction if you did your charitable giving over a number of years. So it could be a great tax benefit to do it all at once, but even more so by using appreciated securities, long-term appreciated securities. You're avoiding the tax on the gain if you were to have sold that position and then funded your charitable giving. So there are a lot of options in charitable giving, and we certainly want to encourage people to continue to support our local organizations who are doing such a phenomenal job in our community, helping those folks in need right now. And so great question.
Thank you so much. And we are at the end of our program now. I know Judy Ann had a couple updates she wanted to give on some upcoming events that are excellent resources for our community.
Just real quick, I put in the chat a link to register. Obviously, we'll take into account the feedback from the polls and come up with some of those topics you guys are interested in. But we are doing a webinar next week, a week from today. It's actually at 5 p.m. if you're available. And the link's in there. It's basically going to be an update from our tax team on the 2019 changes and filing, and a little bit of a touch on 2020 tax planning that people can be doing right now. And then in addition, also next week on that same day, earlier in the day, we're sponsoring the Chamber's virtual networking, and I know they're doing these on a regular basis. I've attended a couple. I find them extremely valuable, so shameless plug if you can. Try to attend these virtual networking events. I really find it's actually easier than in-person networking because the travel time is reduced. And so I just wanted to kind of throw that in there before we close the webinar.
Great. Thank you so much, Judy Ann. And thank you to all our presenters, Connor, Tim, Lori, and Judy Ann again. We really appreciate you, our presenting sponsor, and everyone at Valley National Financial Advisors, and all of our attendees for joining us today. We appreciate you taking the time to be with us virtually while everyone continues to social distance. The Chamber will continue to provide you with the latest COVID-19 resources, important updates, webinars, and virtual networking opportunities like the one Judy Ann mentioned. So stay tuned, check our website and social media pages often. On behalf of everyone here at the Greater Lehigh Valley Chamber of Commerce, we hope you and your loved ones stay safe and stay healthy, and we hope to see you all very soon. Thanks again, everyone. Have a great rest of your day.
Thank you very much.